Plug Power, trading under the ticker DLUG, is currently priced at $3.26, experiencing a significant intraday drop of 3.97%. While many might see this as just another volatile day for a notoriously choppy stock, the underlying mechanics of this specific downturn tell a far more interesting story. This isn't random market noise. This move is being driven by a palpable tension in the options market, where a large volume of put options with near-term expiration dates are seeing unusually high activity. This suggests that some large players are not just selling shares, but are actively placing bets on further downside, or, at a minimum, hedging substantial long positions against a near-term drop. It's a signal that the expectation of a quick rebound is being directly challenged by the reality of sophisticated financial maneuvering happening just beneath the surface. The common narrative surrounding Plug Power is one of boundless potential. For years, investors have been sold a vision of a future powered by clean, green hydrogen, with Plug Power at the very center of this new energy landscape. The company is positioned as a vertically integrated leader, set to produce green hydrogen, build the infrastructure to deliver it, and manufacture the fuel cells that consume it. This is the expectation, a one-stop shop for the hydrogen economy, a company on the cusp of dominating a multi-trillion-dollar industry. The reality, however, as reflected in today's sharp decline from an open of $3.38 to a low of $3.15, is a company grappling with severe and immediate financial pressures. The market's patience is wearing thin as it waits for this grand vision to translate into tangible, sustainable profit. The story is no longer about what Plug Power could be in 2040. It's about whether it can survive 2026 without significantly more shareholder dilution. Today's price action is a microcosm of this conflict. The stock gapped down slightly at the open and then fell sharply in the first hour of trading. This kind of move, especially on higher-than-average volume, often indicates an institutional seller is offloading a position. The subsequent bounce off the $3.15 level shows that there are still dip buyers and retail investors who believe in the long-term story and see these drops as opportunities. However, the failure to reclaim the opening price suggests the selling pressure remains dominant. This tug-of-war is happening against a backdrop of a nervous broader market. The entire alternative energy sector has been under immense pressure due to macroeconomic headwinds. With interest rates remaining elevated, the cost of capital is high. For a company like Plug Power, which is incredibly capital-intensive and burning through cash to build out its production facilities, high interest rates are a direct and potent threat. Every new plant, every new electrolyzer requires massive upfront investment. And financing that investment is now more expensive than it has been in over a decade. This isn't a theoretical risk, it's a direct hit to the company's financial model and its projected timeline to profitability, a reality that the market is clearly pricing in today. This brings us to a critical and often misunderstood aspect of Plug Power's current situation: the immense short seller pressure. The stock is not just facing skepticism, it is a prime target for bearish bets. Currently, the short interest in Plug Dollar hovers at a very high level, often exceeding 20% of the public float. This means that for every 5 shares available to trade, 1 is being used to bet against the company. The thesis of these short sellers is straightforward and grounded in the company's financial statements. They point to a long history of negative cash flow, consistent net losses, and a pattern of raising capital through the issuance of new shares, which dilutes the value for existing shareholders. They argue that the company's ambitious projections are untethered from its operational execution, and that the promises of profitability are a perpetually moving target. The rising cost to borrow shares of Plug Dollar is another red flag that investors should monitor. As more traders want to short the stock, the fee to borrow those shares from a broker increases. Spikes in this borrow rate can signal intensifying bearish sentiment. For retail investors trying to navigate this, it's essential to know where to find this information. Websites like Fintel and Ortex provide daily updates on short interest, borrow fee rates, and even fail to deliver data. One key metric to watch is the days to cover, which estimates how many days it would take for all the short sellers to buy back their shares based on the average daily trading volume. A high days-to-cover ratio can sometimes create the conditions for a short squeeze, but it's a high-risk strategy that can backfire spectacularly. It is crucial to understand the short thesis rather than just dismissing it as market manipulation. What's your take on the rising short interest? Smart money seeing fundamental flaws or coordinated pressure on a developing industry? The reality is likely a combination of both. The bears have valid points about the company's financial health, but the sheer concentration of short positions also makes the stock susceptible to sharp, sentiment-driven rallies. Investors should be wary of chasing these squeezes and instead focus on whether the company is hitting its operational milestones, which is the only sustainable way to prove the short sellers wrong. To understand the core of this conflict, we need to look at what Plug Power actually does. The company is a pioneer in hydrogen fuel cell technology. Its primary products are fuel cell systems that replace lead-acid batteries in electric material handling vehicles like the forklifts you see in warehouses for major customers like Amazon and Walmart. This has been its bread and butter business for years. The grander, more ambitious part of its strategy is the vertical integration into the green hydrogen market. The company is building plants across the United States, most notably in Georgia and New York, to produce green hydrogen through electrolysis powered by renewable energy. The plan is to not only power their own fuel cell customers, but to sell this hydrogen to a broader industrial market. This is where the expectation-reality gap is widest. Building this ecosystem is phenomenally expensive. The company's recent earnings reports have shown a staggering cash burn rate, and while management has guided for significant revenue growth, it has come at the cost of deep operational losses. Past performance has been a story of great promise followed by disappointing results, and the market's memory is long. Investors have seen this before, and the current sentiment reflects a show me, don't tell me attitude. Looking forward, the path for Plug Power is a perilous one, with powerful catalysts and significant risks in equal measure. On the positive side, the biggest potential catalyst is government support. The Inflation Reduction Act includes a lucrative $3 per kilogram tax credit for the production of clean hydrogen. For Plug Power, securing the most favorable interpretation of the rules for this credit is not just a bonus, it is fundamental to the economic viability of its entire green hydrogen strategy. A positive final ruling from the Treasury Department could dramatically alter the company's financial projections and send the stock soaring. Another major catalyst would be the announcement of new, large-scale contracts that go beyond material handling, perhaps in stationary power or heavy-duty transportation. Finally, simply executing on their current projects, getting their plants running at full capacity, and demonstrating a clear path to reducing cash burn would do more to restore investor confidence than any press release could. Conversely, the risks are equally stark. The primary risk is financial. If the cash burn continues at the current rate without a corresponding ramp-up in high-margin revenue, the company will inevitably need to raise more capital, leading to further dilution. Any delays in their plant constructions or failures to meet production targets would be severely punished by the market. Furthermore, competition is heating up, with industrial gas giants and other energy players also moving into the hydrogen space. While Plug Power has a head start in some areas, it does not have an insurmountable lead. The macroeconomic environment remains a persistent threat. If rates stay higher for longer, the entire growth stock thesis comes under more pressure. For investors, the next few quarters are absolutely critical. The key metric to watch will be the company's gross margins. For years, they have been negative. A clear and sustained turn towards positive gross margins would be the first tangible sign that the business model is starting to work. Comment below if you believe Plug Power can achieve positive cash flow by 2026. In summary, the story of Plug Power today is one of a monumental clash. On one side, you have the powerful expectation of a company set to lead a global energy transition. On the other, you have the harsh reality of a balance sheet under strain, operational hurdles to overcome, and a legion of short sellers betting on its failure. The 3.97% drop we are seeing today is not just a number on a screen. It's the market's real-time verdict on this ongoing battle. The path forward is not for the faint of heart. Investors must look past the hype and the fear and focus intensely on the company's execution. The ultimate success or failure will not be decided by Reddit forums or analyst targets, but by the cold, hard numbers on the income statement and the cash flow statement in the coming quarters. The grand hydrogen vision is still intact, but the financial runway to get there is getting shorter.